Now coming to merger arbitrage funds. So again, these are those hedge funds which will focus on any kind of mergers and acquisitions activities which happen in the marketplace. Now, whenever we talk of a merger or acquisition which is being announced, there is a certain degree of risk which it entails, because after the announcement of a merger, before the actual merger goes through, there could be various hurdles which would come up. So there could be regulatory issues, or there could be antitrust problems, or there could be shareholder opposition, etc., or a host of other problems. So that way, there is a significant amount of risk before the actual merger goes through. But these kind of hedge funds who focus on merger arbitrage strategies would be betting on that merger going through, so that their investment generate the required return. Now, whenever we talk of the M&A scenario or mergers and acquisitions in the industry, there are two ways in which a M&A transaction generally happens. One could either be a all cash deal, or it could be a all stock deal. Now, there can be a combination as well, but here we'll take these two scenarios, the two which are most popular. So, talking of the all cash deal first, let's say company X announces to acquire company Y, or and they will do it through a all cash transaction, and they will do it at a price of $50 a share. Now, prior to this announcement, let's say company Y's share was trading at $35. Now, post this announcement, the trading starts and this trading price jumps to $48. Now, because of this merger, which could potentially happen, we see a upside which happens on company Y stock, which is the company which is going to get acquired. Now, what a hedge fund would do is they could purchase the shares of Y at $48, and they will wait for this price $50 to be achieved. That is, if the merger goes through smoothly, then the trading price will move to $50, and the difference, $50 minus $48, will be the $2 profit which the firm will earn as a part of this transaction. So that is how the hedge fund generates a return on such a trading strategy. Next can be a all stock deal. So let's say company X is going to offer shares in exchange for acquisition, and the proportion could be that it will offer one share of its stock for every four shares of Y. So we have like a 1:4 ratio. So a hedge fund will buy a certain number of shares of company Y, and it will short one fourth that number of shares of company X. Now, there is a reason behind this shorting strategy. This is because the firm which generally acquires, they end up paying slightly higher, or they end up paying a certain premium price over the market price, and that is why the stock usually goes down. And that's why generally the fund would like to take a short position in certain number of shares of company X, and how much will be that share depends on the proportion which is being offered. So here it was like a 1:4 proportion, so there we spoke of one fourth the number of shares. So that way, uh, hedge funds can enter into such strategies. So this is what we call as a strategy for an all stock deal.